Welcome to our webinar today on the 3 essential components of a risk tolerance profiling system. My name's Craig Saunders and I'm going to be your host and your mouthpiece for the next half hour or so. We are live here today, so please feel very welcome to send in your questions or your comments as we're working through these matters. I see them on the screen just next to me here, and you can guide where our discussion goes today. Soon I'm going to be joined by Paul Resnick from FinaMetrica. He's going to be our guide through those 3 essential components of a risk tolerance profiling system. FinaMetrica, as you probably know, is a leading global supplier in this area. So first, a couple of procedural matters to get through with you. If you're not already a FinaMetrica subscriber, please visit our website at riskprofiling.com, where you can sign up for a free trial of the entire FinaMetrica system. You get to use every part of that system. You can do as many tests as you like for yourself, your family and your clients. And using the system will show you how our test is delivered online and how the results get fed back to both the advisor and the client. So please feel welcome to sign up for that trial. It only takes an email address. There's no credit card details required there at all. Also at riskprofiling.com, a couple of other resources that might interest you. The first is a podcast called Financial Planning Conversations. You can get that either at the site riskprofiling.com, or you can subscribe through iTunes and have it delivered to you every 2 weeks. Every 2 weeks, Paul Resnick and I talk through the good and the bad of financial advice and explore ways to deliver better outcomes to clients and their advisors. So back on the website, you can find that on the resources tab in the far right-hand side. Meanwhile, also at riskprofiling.com, you can watch all of our recent webinars. They've all been recorded over the past couple of months, and they expand on all of the issues that we'll be touching on here today. So if you're looking for a little bit more depth, because we're going to be taking somewhat of a bird's eye view, please refer back to those webinars. I'll give you a bit more detail on those as we come to the end of the show. So the 3 factors of a risk profiling system, and I know that some of you will already be saying, hang on, what could number 2 and 3 be? Isn't it just a test? Well, a good, reliable test of financial risk tolerance is certainly the first step, and it's a really crucial step. Get the assessment wrong and everything that flows after that assessment will be wrong as well. And we'll be talking today about why a psychometric test is really the gold standard when it comes to testing financial risk tolerance. But there are 2 more steps that are also often ignored. The first is to map that risk score to a portfolio or to an investment. And that's a more sophisticated process than some people often think. It's often more than just matching one number to another. Then the third step is to use that risk score and the investment decision that you've just made as the basis for framing and managing the client's investment expectations. Now, this is a really critical step. Pre-warning people of the volatility that their investments might experience is crucial to keeping them invested when that volatility arrives. Now, in a moment or two, I'm going to be joined by Paul Resnick. The system's just working through bringing him online for us now, and he'll be guiding us through these 3 factors of a risk tolerance profiling system. I see Paul's just popped up now. Paul is a director and co-founder of FinaMetrica, which has been a world leader in this field for over 20 years. Hi, Paul. Welcome.
Morning, Craig.
Now, the FinaMetrica 3-factor model is assess, invest, and frame manage. Do you find people commonly doing steps 2 and 3, or are they just doing a test?
Well, often we're framed or we're compared to other tests in the marketplace. We've been going at this now, I think it's almost 25 years since we started thinking about how we could help advisors, their clients, and their money speak to each other in a meaningful way. And we still find people look at the test as something they must do to meet regulatory standards and don't use it as a tool to help them and their clients better match investments to both their psychological needs, their preferences for risk, and their needs to have money available to meet liabilities as it falls due going forward. So still a bit of shortcutting going on. Still people not getting the full benefit of their subscriptions and the help we can give them to make their clients' lives richer, if you will.
Now, the FinaMetrica test, Paul, is built around psychometrics. Why do you argue that's really the only reliable way to measure financial risk tolerance?
Well, risk tolerance, we started off naively. We didn't know what it was. What we wanted to do was find out, was there a way of consistently framing an investor's experience? And we looked at an array of mechanisms, and psychometrics was the one that jumped out. Much to many people's surprise, people's preference for financial risk, that their risk-taking ability is in fact relatively stable, and that's because it's a function of personality. Personality doesn't tend to change over time, or with experience, or with education, or by country. When you use other mechanisms, and there are many on the marketplace, the most obvious ones are just 2 or 3 questions that have been glued together and put into what we call a risk profiler, which takes into account time horizon and a few other factors and throws out a portfolio. And more recently, things around gamble theory or prospect theory, which are looking to see if there's a relationship between the emotional cost of a dollar lost versus what gain you need, sometimes $2, sometimes $3, sometimes $4 to feel the same. Both are don't provide either a view of a stable and reliable number, nor do they recognise that it's a long-term risk tolerance you're trying to understand, not a short-term preference for one number over another. So psychometrics does it with validity, reliability, and consistency. Over time, we've now completed 1 million tests, and while our tests may seem a little longer than others, it actually gives an accurate number.
I just want to go back to that point that you raised about risk tolerance being a personality trait, and this is, in our experience, one of the much misunderstood areas. People think that risk tolerance changes because of the weather, because of the experience from last night, that it's a very variable thing, but there's a lot of research that says that it is in fact a personality trait that's stable over time. And I just want to talk about what that means. So being stable over time, a shy person doesn't normally wake up one day suddenly being gregarious and outgoing, because they have patterns of behaviour and thoughts and emotions that go along with being shy. So that's a personality trait, and people tend to be who they are over time. And that's different to what we might call, Paul, a disposition, which is more of a measure of a mood or a feeling. And as we know, moods and feelings vary dramatically, and so they're not really a good solid basis for a reliable measurement.
Yeah, that's a good way of looking at it. We often just talk about the distinction between a state and a trait. A trait is a relatively enduring way one person differs from another. A state is where you are at this moment, and we've all been with people before and after market crashes. I remember vividly post 1987, the market crash, and the number of very, very disturbed investors visiting me in my office on St Kilda Road, angrily saying they had no expectation of how bad the performance in their funds were, and were totally unprepared for it, and were very angry. In a sense, that was the trigger for establishing FinaMetrica. I had seen firsthand very, very unhappy investors. Now, some of those people I still know, they're people I met in that early period. What I can tell you is that the state varies. After a couple of years, their confidence returned, their ability to talk confidently and to reinvest back in the market. But, and as I now know, and after now 1 million tests, I can say with great certainty, the trait is stable, the state varies with mood, with market confidence, with what their friends are doing, their liabilities, their own particular personal circumstance.
It's funny you mentioned being on the phone back in '87. I was in that same road at the other end of it in another office, taking phone calls from, at that time I was administering an international equity fund, and it launched 2 weeks prior to the 1987 crash, and so I had investors on the phone who'd been invested for 4 days and lost 25%, and they were horrified, and it was just a story of human misery. And that's, I think, is a good point to make, Paul, that you need to get this right, because otherwise there's stories of human misery that underpin this.
Well, clearly, in 87 and again in 2000, 2007, 2008, the critical issue, and we've been talking about it now for almost 20 years, is risk tolerance is a psychological preference, but you need to take into account risk required and risk capacity. Capacity is effectively, could you still meet your liabilities when the market's in a sustained correction? And in some countries, 2000 was a 5, 6, 7 year recovery. Every country is different, every portfolio is different. That's why we provide the mapping and the framing expectations, because you can't generalize from one asset class or one country through this process. You actually have to look at the makeup of each individual portfolio. You can generalize a little, whether they're property assets, local or international, or equities, but you must be very careful in the framing that you don't oversimplify what can happen.
We'll move on to the mapping and the framing in just a moment. I just want to note for people that there are 2 webinars that explore the test in a lot more detail, and also how to audit your process in quite a bit of detail. It's a checklist that you can work through to test whether your test is up to scratch. But Paul, you mentioned mapping, so let's go there now. That's step 2 that comes after the test and you've got the result. Just briefly describe for me what mapping is.
Well, after you've undertaken the test, we provide a score, and we put that in the context of 5 or 7 risk groups, 7 risk groups if you do a 25-question test. And we encourage the advisor to talk with the client and to confirm that that is their risk tolerance and that their score is reasonable, that it is consistent with their answers and they're comfortable with it. We then take that score and we look at the correlation with that score with the answers to a portfolio question within the 25, which has been we've seen to be fairly tightly correlated over time. And we say that score will give you a portfolio, give you an example. If you scored, say, 55, that you would be comfortable with a portfolio which has something between 40 and 60% growth asset exposure, because that would be the portfolio that's consistent with your risk tolerance. It may or may not meet your risk capacity or your risk required, but at least we've got a link from where you are as a person, what sits in your heart and mind, to a portfolio, and we can start exploring whether in fact that's the right portfolio to meet that individual's needs.
Now, I've just brought up a diagram that sort of explains to an extent this exploring. A lot of red on each side, then a band of yellow with the band of green in the middle is what everyone should be seeing now. And I've just dropped an arrow in around about that risk score of 50. And what that's telling us here on this diagram is that a 50% growth asset portfolio is going to be in the green for these people. But take them up to 70% and suddenly you're into the red. Take them down to 20% and suddenly you're into the red. And these are the discomfort zones where there might be too much risk. But Paul, this band here of the yellow and green, that's actually telling us that there's a range of acceptable outcomes here. It's not necessarily that a risk score of X ties you to a specific portfolio of Y. It might mean that you're open to portfolios ranging from C to F, for example.
Correct. What we've seen looking backwards and looking at portfolio performance is what you're trying to do is making sure that you don't make some huge mistake, that you get somebody in their extreme discomfort zone. But when we look at volatility, having plus or minus 10% equities in an overall portfolio, particularly if it's got currency exposures in other countries, leaves you with not a huge amount of difference. And so it's not to be precisely right. It's not to be precisely wrong is the critical issue. And as we model through, we've now looked at portfolios going back as far as 1970 in 9 countries. So there's a very clear pattern that looks surprisingly like the efficient frontier, that as you increase equity exposure beyond about 50%, you start engaging levels of volatility without necessarily having historically increased performance significantly for the additional level of risk.
And yet that's a real life conversation that most advisors would be having every day with people, to say, look, you might need to take a higher level of risk on board if you want to achieve your goals. I guess what we're talking about here is a gap analysis between what people have and where they need to get to, and whether the risk that they want to take on aligns with the risk they need to take on.
And that's the critical issue, isn't it? So often in investment advising, advisors take on the responsibility of determining the right portfolio for the client. Once you take into account what people need to take and what they're capable of living with, you've added those 2 additional factors are in fact quite adjustable. So let me give you an example. It might be that you and the client believe they need a 70% exposure to growth assets, but in discussion discover that they've got other assets that haven't been included in the construction of the portfolio. There may be some future inheritance that's coming in. It may be that they're living in a much too large a house and they're planning to downsize and move closer to the children in a few years' time, all of which can be applied to a view that you don't need to take such a large amount of risk to achieve your goals, or even the simplest one of working an extra couple of years and not spending quite as much money. So the basic algorithm, risk required, risk capacity and risk tolerance, there's one that's fairly stable, and that's risk tolerance. The other 2 are a function of that individual's lifestyle and circumstances, and can be talked through, so the client owns the outcome, not the algorithm, not the advisor.
You've mentioned talking it through with the client, and in our previous conversations you've been very strong on one of the benefits of FinaMetrica is the conversations that it enables advisors to have with clients, the opportunity to work through and say, look, here's something about you, here's something about potential investments, how do we make these 2 match up together? That's where the secret sauce is, if you like.
It's the confidence that people can understand themselves. We often have a debate with advisors about collaboration versus paternalism. It's been even from the time we launched almost 20 years ago, a number of advisors were saying the clients come to us and we tell them what to do. And we always found that uncomfortable. That this is the client's life, and we always argued that the exercise is around collaboration and informed consent. Informed consent, having transparently explained the range of outcomes, means the client owns their life, not the advisor who's told them what to do. It's a much safer way of proceeding because it means that there's a shared liability. The client has had explained to them the consequences of their behaviour. If they continue spending, they're going to run out of money. If they continue saving, they're taking far more risk than they need to do. And people shouldn't be terrified of their money. They should work with it and know the constraints. That's quite clear. Some people will still prefer to be told what to do. But to a very large extent, when we talk to our advisors, they're very comfortable. They've now got a language of sharing so that the client collaboratively can own their plan. And the whole basis for ongoing advice is to see where things are compared to where we thought we were last year. And everything is telling us that market timing portfolios doesn't pay a premium, but being in a portfolio for the longer term, not being emotionally disturbed by market volatility, and managing what's manageable is a better outcome for clients than the alternatives.
not being concerned by market volatility sounds easy, but it's perhaps a bit harder, because that's when people really get tested. When the pressure comes on and the heat comes on, we know from statistics that many people end up selling out at the bottom of the market. So the antidote to that, if you like, Paul, is to frame people's expectations so that they don't get so much of a surprise when that sort of volatility occurs. Tell me how and why a risk-return guide fits into that. This is step 3 now, the framing of investor expectations and then managing that when that volatility comes.
So what we built was, for every country, major country we're in, we've gone back as far as we could find reliable records of the major indices, accumulation indices, and have constructed, I think it's now 20 storyboards that will help advisors frame their clients' expectations. So here you can see the 11 for the US, and they start off with 100% in defensive assets going down to 0, so in 10% increments. And you can see the mixture of assets in each portfolio: cash, bonds, US stocks, and foreign stocks. So what we're trying to do in this case is provide a generic framework of portfolio behaviours that would be consistent with almost any risk score that emerged from a client's test and has been mapped across to.
And from that data, you mentioned that you have a number of storyboards. I'll pop a few of these up on the screen. So, for example, this is somewhat of a visual representation with your chart that's talking about here's your portfolio, but then it's talking about what risk group are you in and what do you expect returns to be. And there's a lot of valuable data in here for advisors to be able to say to somebody, look, you're anticipating that your investment is going to give you a return of twice bank bill rates, for example. That might be optimistic. Maybe 1 to 1.5 times is the best that you can do. And this is the sort of data that unlocks those conversations for you.
Well, I think what we found is when we did our original research, nobody actually understood performance. So we locked things into bank deposit rates. And we found an asymmetrical relationship. The more risk-tolerant people are, the more they're optimistic about performance, that they expect they're going to get 2 or 3 times the BD rate, or the CD rate, I believe it is in the US, when in fact that doesn't happen. And if we look carefully at that example there, I think you'll see that the range of returns are quite broad as you go up taking more risk, but still on average 1.5 times the CD rate is about what you would have got over the last 45 years on a rolling 10-year period.
Now, once again, we have a webinar just on these risk return guides that step you through a lot of the data in here. I'm just going to click very quickly through. This is a more visual pane that we're seeing here for people who take in their information that way. Here's a more numeric one. Now, we could spend an hour just talking about this page, Paul, and in fact we spent half an hour talking about a page very similar to it in that other webinar, because there's just so much data in here. And if we look at historical real annualized returns, for example, for this portfolio over a 10-year period, the best was 11.9%, which sounds great, but the worst was minus 2.4%. We're talking about roughly the same sort of portfolio. It's just a lot of fine-tuning and fine difference comes into there, and this really helps you to tease that out, because as we've discussed before, you can't necessarily believe performance numbers that come from people who run the money.
I think that's right. I think they see everything comes from the money perspective. What we've learned very early when we started our exercise, we need to see things the way the client will see them, and that's why we've done things in percentages and in dollars. We've always tried to deal with it the way they would prefer to see it. So we have a narrative, we have numbers, we have pictures, we have graphs. And what we're trying to do is to take out the surprise. I think that the line is, you may be disappointed with what your portfolio performance looks like, but you should never be surprised. And we looked, as many people did, and read Taleb's The Black Swan and all of the issues around the extreme portfolios. And that's why we don't work on the 95% value at risk, the 2 standard deviation, because our clients, your clients, also exist in that final extreme case, the 5%. And you can be rest assured, as you were talking about in 87, you'll put somebody into the market 2 days before there's a major correction, and it will be horrific. And it could well be the next time that it's the largest correction since the 1843 correction. You've never framed anything to a client around that. All we can go back to is 1970 or 1972. So you must paint the bottom 5% and the top 5%. It may happen. It could well happen in the next couple of years, and it could last for 5 or 10 years while the markets unravel.
And to put a point on this, Paul, a pointy end, surprise clients are potentially unhappy clients, and unhappy clients do potentially 2 things. One is to leave you and take their custom to somebody else. The other is to sue you and take action against you. And one thing we know around the world, when financial services companies lose in court, it's generally because someone can show, hey, look, they gave me a product that was unsuitable for me and didn't tell me about it.
Well, certainly when we look now at the analysis that comes out from various ombudsman services around the world, courts are a little harder, the formal courts, because often actions are subverted by pre-judgment agreements, so you don't see them reported. But in many countries where the ombudsman services are reported, failure to meet clients' needs is regularly seen as the first, second, or even combined reason for complaints. And you could see the reason why. Your Honour, nobody told me it could be this bad. I thought they understood my needs. It's sort of like saying you've gone in to buy a shirt and it's 6 sizes too large, and when you washed it, it shrank, and now it's 2 sizes too little. Now, if you paid $2 or 2 shillings to $2 for the shirt, you wouldn't be surprised that it didn't wear particularly well. But if it was a brand name and you paid a full price for it, you wouldn't expect it. So that's what framing is about. It's setting expectations that are realistic, and that means that the advisor understands the range of volatilities that portfolio may deliver, and in turn has done a due diligence on the fund manager and the way the portfolio is constructed to make sure that there are reduced levels of uncertainty. So to give you an example, you'd be very nervous in framing if you had a fund manager that could say they're going to go to 100% cash if they believe the market's overpriced. While in theory that sounds good, in a vast number of cases I experienced over my career, they do that on the wrong day. They go fully exposed before a correction, and they go very light just before the market burns.
Now, Paul, we want to keep to time today, and so we'll stick with our bird's eye view, and we're going to have to leave it there for this morning. Thanks very much for being with us.
Thank you, Craig.
Now, folks, before we go, I want to tell you more about those webinars that I mentioned earlier, because there's a number of them that will expand on the topics that we've been talking about today. They're all at riskprofiling.com. You can watch detailed programs about why psychometrics are the gold standard for assessing financial risk tolerance, how to map tolerance to investment decisions, and framing and managing investor expectations using those risk and return guides. And there's also a program there walking you through the audit process if you want to review your risk tolerance process and see whether it's up to scratch. Those videos are all at riskprofiling.com resources/webinars. Also, while you're at riskprofiling.com, as I mentioned earlier, if you're not a subscriber, please feel very welcome to take on board a 30-day trial of FinaMetrica. You'll be able to see and do everything that full subscribers do for a month and get to know the system and what it can do for you and your business. And that's it for today's webinar, folks. Thanks very much for being with us. We do appreciate your company and taking the time out of your day. From all the team here at FinaMetrica, have a great day. I'm Craig Saunders. Goodbye for now.